Every government says it works for the people. Every election promises stability, prosperity, growth. New slogans, new faces, same assurances. But behind the speeches and campaign rallies, behind the flags and the applause, there exists another authority. Quieter, more technical, almost invisible. It doesn't ask for your vote. It doesn't appear on ballots. Most citizens couldn't name its leaders even if they wanted to. Yet this institution decides how much money exists in your economy. It decides whether borrowing is cheap or crushing, whether banks are rescued or allowed to fail, whether savings quietly erode or debts slowly disappear. This power belongs to the central bank. Central banks do not rule with armies or laws. They rule through interest rates, liquidity, and credit. Through spreadsheets rather than speeches. Through decisions that feel abstract, until suddenly your mortgage jumps, your retirement shrinks, or your job vanishes. And they can do all of this without a single vote cast by you. This is not a conspiracy. It is history. This is the hidden story of how central banks became the true custodians of modern power. How institutions created to stabilize governments evolved into engines that shaped the fate of nations. And how the same mechanisms that once financed kings and wars now quietly govern the global economy. To understand how we arrived here, we have to rewind centuries, back to a time before central banks were technocratic giants, back when money itself was scarce, heavy, and brutally real. The 17th century was not an age of financial sophistication. It was an age of war. Europe was locked in near-constant conflict. Empires rose and fell on battlefields. Kings spent lavishly. Armies devoured silver and gold faster than treasuries could replenish them. And governments faced a recurring problem that still haunts them today. They needed money, and they needed it urgently. Taxes were slow, loot was unreliable, and borrowing was dangerous. In England, this problem reached a breaking point under King William III. The crown was locked in an expensive war against France, and the cost of modern warfare was escalating. Muskets, ships, mercenaries, none of it came cheap. But lenders were cautious. England's monarchy had a reputation for defaulting. Kings could simply refuse to repay debts, imprison creditors, or rewrite terms by force. Trust was fragile, and capital does not flow where trust is weak. So a new idea emerged, a radical one. What if the state itself partnered with financiers? What if debt became institutional rather than personal? What if promises could be standardized, tradable, and protected by law? In 1694, that idea took form as the Bank of England. This was not merely a bank. It was a political innovation. In exchange for lending money to the government, the bank received a unique privilege, the right to issue banknotes, paper claims backed by government debt. For the first time, money in circulation was no longer only metal coins. It was credit, paper promises guaranteed by the state. This changed everything. The Bank of England became the government's creditor, its financial agent, and eventually its guardian. It managed debt issuance. It stabilized markets. It created liquidity when the state needed it most. And slowly, almost imperceptibly, power shifted. Because once money becomes credit, whoever controls credit controls the state. This was the lesson that echoed across Europe. England was not the first to experiment with central banking. Sweden had founded the Riksbank in 1668, but it was the British model that proved transformative. Over the 18th and 19th centuries, central banks spread across Europe like infrastructure for empire. They were not created out of academic curiosity. They were built for war, expansion, and survival. Empires do not run on courage alone. They run on balance sheets. During the Napoleonic Wars, this reality became impossible to ignore. Napoleon's armies marched across Europe, but France struggled to finance its campaigns consistently. Britain, by contrast, borrowed relentlessly. The Bank of England enabled Britain to raise vast sums at relatively low cost. Its credibility reassured lenders. Its notes circulated widely. Its debt became trusted. The result was not just military endurance, but financial dominance. By the early 19th century, the pound sterling, backed by Britain's banking system, had become the world's reserve currency. Global trade flowed through London. Insurance, shipping, commodities, and finance all converged around British credit. Wars were still fought with cannons and soldiers, but they were increasingly won in the ledgers of central banks. This was the unspoken truth of empire. Financial endurance outlasted battlefield glory, and once again, others took note. Across the Atlantic, the United States followed a very different path. For much of the 19th century, America had no true central bank. Its financial system was fragmented, decentralized, and volatile. Thousands of banks issued their own notes. Confidence varied wildly. Panics were frequent. When trust failed, everything collapsed at once. The most dramatic example came in 1907. A speculative bubble burst on Wall Street, triggering bank failures across the country. Depositors panicked. Credit froze. Businesses shut down. The entire financial system teetered on the edge of collapse. And in that moment, the U.S. government did nothing. There was no institution capable of acting quickly, decisively, or at scale. Instead, salvation came from one man, J.P. Morgan. From his private mansion, Morgan summoned the heads of America's largest banks and trusts. He locked them in a room. He forced them to pool resources. He dictated terms. He provided liquidity. And he stopped the panic. One private banker had stabilized the U.S. financial system more effectively than Congress or the Treasury. For the political elite, this was deeply unsettling. If one man could wield this much power, what would happen next time? The answer was clear. America needed its own central authority. Not a king, not a financier acting alone, but an institution with similar reach, sanctioned by law. The solution would come quietly, behind closed doors, and it would reshape the modern world. The lesson of 1907 was not forgotten. It lingered in the minds of politicians, bankers, and industrialists alike. America could not afford to depend on the will of one man again. But creating a central bank in the United States was politically dangerous. The memory of earlier banking institutions still carried the stench of elitism and corruption. Populist movements feared that a central bank would become a tool of Wall Street, a private cartel masquerading as public good. So the solution had to be subtle. In 1910, under the cover of secrecy, a small group of powerful men gathered on Jekyll Island, a private retreat off the coast of Georgia. Officially, they were there for leisure. In reality, they were designing the blueprint for America's future financial system. Among them were senior bankers, Treasury officials, and political insiders. Their names would later fade from public memory, but their influence would not. What they drafted was a compromise, an institution that looked public, felt independent, and yet remained deeply intertwined with private finance. 3 years later, in 1913, Congress passed the Federal Reserve Act. The Federal Reserve System was born. It was not a single bank, but a network, part public, part private, technically independent, yet politically indispensable. The Fed could issue currency. It could set interest rates. It could act as lender of last resort. In theory, it was meant to stabilize the economy. In practice, it became America's financial engine. Privately influenced, publicly sanctioned, few citizens understood what had just been created. Even fewer grasped the long-term implications. Monetary policy sounded dull, technical, remote. But history would soon reveal how decisive those tools could be. The first test arrived almost immediately. War as a financial accelerator. World War I was not just a military conflict. It was an economic shockwave. Industrial warfare demanded resources on a scale the world had never seen. Nations mobilized entire populations. Factories ran nonstop. Governments spent beyond anything their tax systems could sustain. No country could pay for this war with gold alone. So central banks stepped in. They issued bonds. They expanded credit. They printed money. The gold standard, once the anchor of global finance, was quietly suspended. Convertibility became optional. Survival became priority. This was the turning point. For the first time, central banks openly financed governments during total war. The printing press was no longer an emergency lever. It was policy. The consequences were immediate. By the war's end, inflation swept across Europe. Currencies weakened. Savings evaporated. And nowhere was the damage more extreme than in Germany. Under crushing war reparations and political pressure, the Reichsbank printed money relentlessly. Marks flooded the economy until they were worth less than the paper they were printed on. Hyperinflation destroyed the middle class. Workers were paid twice a day so they could spend wages before prices doubled again. Wheelbarrows of cash, bread costing billions. savings wiped out in months. Weimar Germany remains the most infamous example of monetary collapse, but it was not the last. And crucially, it did not end the experiment. Instead, it taught a different lesson. Central banks were now indispensable for growth, for stability, and for destruction. The Depression and the power of inaction, the next great test, came in the late 1920s. Speculation gripped financial markets. Cheap credit fueled stock bubbles. Optimism drowned out caution. When the market finally cracked in 1929, panic spread rapidly. Banks failed. Credit vanished. Businesses collapsed. This time, the central bank did exist. But the Federal Reserve hesitated. Instead of flooding the system with liquidity, it tightened policy. It allowed banks to fail. It watched as deflation spiraled and unemployment soared. The result was the Great Depression. Economists still argue about the Fed's role. Some say it lacked the tools. Others argue it misused them. But history delivered its verdict regardless. A central bank's choices, or refusal to act, could devastate entire societies. Millions lost jobs. Families lost homes. Trust in institutions shattered. Governments took notice. After World War II, they resolved that such chaos would not happen again, or at least not on their watch. Bretton Woods and the Age of Dollar Empire in 1944, as World War II still raged. Representatives from 44 nations gathered in Bretton Woods, New Hampshire. Their goal was ambitious: to rebuild the global financial system from the ashes of war. The solution they designed placed the US dollar at the center. The dollar would be backed by gold. Other currencies would be pegged to the dollar. Institutions like the IMF and World Bank would stabilize global finance. On paper, it was cooperation. In reality, it was power, because behind this system sat the US Federal Reserve and the US Treasury. America emerged from the war with intact industry, vast gold reserves, and unmatched influence. Money itself became geopolitics. For decades, the system worked until it didn't. Mounting costs from the Vietnam War and expanding domestic programs strained U.S. finances. Dollars accumulated overseas. Foreign governments began demanding gold. The illusion of restraint cracked. On August 15, 1971, President Richard Nixon made a decision that changed everything. He closed the gold window. The dollar was no longer convertible into gold. The anchor was gone. From that moment on, the world entered the era of pure fiat money, currencies backed only by government decree and managed entirely by central banks. The age of monetary restraint was over, and central banks now held unprecedented freedom. When the gold anchor disappeared in 1971, the rules of finance changed quietly, but permanently. Money was no longer something discovered in the ground. It was something declared into existence. From that moment forward, central banks were no longer constrained by metal reserves or physical limits. Their only real boundary was credibility, how much the public would tolerate before trust began to fracture. And for a time, that trust held. The Volcker shock, power on display by the late 1970s, the consequences of fiat money were already visible. Inflation surged. Oil shocks rippled through the global economy. Prices climbed faster than wages. Confidence in the dollar eroded. In 1979, the Federal Reserve made a decision that demonstrated just how powerful a central bank had become. Paul Volcker, newly appointed as Fed chairman, raised interest rates aggressively. Not gradually, not cautiously, but brutally. Rates surged toward 20%. Mortgages became unaffordable. Businesses failed. Unemployment spiked. Entire sectors collapsed. It was economic pain by design. Volcker understood something fundamental. Inflation is not just a monetary problem. It is a psychological one. To restore trust, the Fed had to show it was willing to sacrifice growth to defend the currency. The recession was severe, but it worked. Inflation collapsed. The dollar stabilized, and the Fed's credibility was restored. A new message was sent to the world. Central banks could reshape reality. They could crush inflation or ignite it with a single policy choice. The hammer had been revealed. Financialization and the long bubble the decades that followed were defined by a different strategy. Lower rates, more credit, ever-expanding markets. As manufacturing declined in Western economies, finance took center stage. Asset prices soared. Stocks, bonds, and real estate became engines of growth. Wealth increasingly flowed not from production, but from financial appreciation. Central banks played a central role. Each crisis was met with easier money, each downturn with lower rates, each shock with more liquidity. The pattern was subtle but consistent. Losses were socialized. Gains were privatized. By the early 2000s, this system had grown fragile. Debt piled up. Risk was mispriced. And when the U.S. housing bubble burst in 2008, the entire global financial system trembled. 2008, the point of no return. Lehman Brothers collapsed. Credit markets froze. Global trade seized up. This was not a recession, it was a systemic failure. And once again, central banks stepped in. But this time, the response was unprecedented. Trillions of dollars were created out of nothing. Interest rates were slashed to zero. Banks were rescued. Markets were propped up. They called it quantitative easing. Technically, it was bond purchases. Functionally, it was money creation on an industrial scale. For Wall Street, it was salvation. For asset owners, it was a windfall. But for ordinary savers, it was something else. Interest on savings vanished. Housing became unaffordable. Inequality widened. The message was clear, even if unspoken. The system would be saved, no matter the cost. And the cost would be paid indirectly. The pandemic acceleration in 2020, the world shut down. Supply chains collapsed. Businesses closed. Governments froze economies by decree. And central banks responded with speed and scale that dwarfed even 2008. Balance sheets exploded. Trillions were printed. Stimulus checks were mailed. Corporations were rescued. Money moved at the speed of keystrokes. What once would have been considered reckless was now routine. Emergency became standard operating procedure. The justification was stability. But the consequences followed. Inflation surged. Asset bubbles inflated. Public debt reached historic highs. And beneath it all, a quiet realization spread. Money is now whatever central bankers say it is. The illusion of neutrality. Central banks often present themselves as referees, neutral, objective, technocratic. But history tells a different story. They decide who gets rescued. They decide who absorbs losses. They decide when pain is necessary, and for whom. Every intervention expands their role. Every bailout deepens dependence. Markets no longer fear risk. They fear central bank inaction. The global economy has become addicted to monetary support, and addictions, by nature, escalate. The pattern repeats. Governments run record deficits, assuming rates will stay low. Banks take reckless risks, trusting rescues will come. Investors chase bubbles, confident in the so-called Fed put. But history is unforgiving. The Bank of England's credibility faltered before. The Reichsbank collapsed into hyperinflation. Bretton Woods dissolved overnight. Every system breaks eventually. The only question is how, and who pays. When central banks act, the effects are not evenly distributed. They never have been. Behind every interest rate decision, every liquidity facility, every emergency intervention, there is an unspoken transfer of wealth. Quiet, legal, technical, but profound. Inflation does not punish everyone equally. Neither does deflation. When central banks expand the money supply, wages lag behind prices. Savers watch purchasing power erode. Cash loses value slowly enough that the damage feels abstract, until years later, when retirement plans no longer add up. But asset owners experience something different. Stocks rise. Real estate inflates. Debt becomes cheaper to service. The winners are rarely named. The losers are rarely acknowledged. This is not accidental. It is structural. The jargon that hides power's central banking language is deliberately complex. Interest rate corridors, open market operations, liquidity backstops, macro-prudential policy. The vocabulary creates distance. It turns political consequences into technical debates. It makes power feel neutral. But beneath the jargon lies a simple reality. Central banks create money. They decide where it flows. No private institution in history has ever wielded this scale of influence without accountability. Yet central banks operate behind layers of independence designed to shield them from public pressure. Independence, in theory, prevents political abuse. In practice, it concentrates authority. And once concentrated, power rarely shrinks. From stabilizers to kingmakers, each crisis expands the central bank's mandate. Originally, they were lenders of last resort, then guardians of price stability, then stewards of employment, then backstops for financial markets. Now they are expected to stabilize everything: stock markets, bond markets, Housing markets, entire economies. When markets wobble, the first question is no longer about fundamentals. It's about central banks. What will the Fed do? Will the ECB intervene? Will liquidity return? The expectation of rescue has become embedded, and expectations shape behavior. Banks take more risk. Governments borrow more. Investors chase higher returns. The system becomes more fragile, even as it appears stable. The trust problem money is not wealth. It is trust. Trust that tomorrow's currency will hold value. Trust that debts will be honored. Trust that rules will not change overnight. Central banks can create liquidity. They cannot create credibility. History is filled with moments when trust evaporated. Weimar Germany, Latin America in the 1980s, Asia in the 1990s. In each case, central banks printed until confidence collapsed. And when trust broke, no amount of money could fix it. This is the risk modern systems face. Not hyperinflation overnight, but slow erosion, a quiet weakening, a loss of faith. The modern parallel today, the world sits at another inflection point. Debt levels are higher than ever. Demographics are aging. Geopolitical tensions are rising. Central banks are trapped between inflation and instability. Tighten too much, and markets break. Ease too much, and currencies weaken. There are no painless choices left. The same dynamics that fueled 1929 echo today. The same moral hazards of 2008 persist. The same faith in central planners remains. History does not repeat exactly, but it rhymes. What this means for you understanding central banks is not academic. When they ease, your savings lose value. When they tighten, your loans become heavier. When they rescue markets, asset owners win. This is not ideology. It is arithmetic. Resilience does not come from promises. It comes from assets that cannot be created at will. Land, skills, productive businesses, scarce stores of value. These have survived every monetary regime. The final paradox: central banks were created to serve governments. They grew by financing wars. They expanded by stabilizing crises. Now they sit at the center of a global financial system that depends on them. They are unelected, unavoidable, and extraordinarily powerful. This is the paradox of modern finance. The people we never vote for control the money we cannot live without. The answers are not hidden in the future. They are written in the past. The story of central banks is often told as a story of stability, of expertise, of adults in the room managing chaos. But when you step back far enough, a different picture emerges. Central banks were not born to serve citizens. They were born to serve states. They emerged when kings ran out of gold. They expanded when wars demanded more than taxes could provide. They matured by turning debt into permanence. From the Bank of England financing imperial wars, to the Federal Reserve stabilizing America's panics, to Bretton Woods anchoring a post-war order, central banks have always been instruments of survival. But survival has a cost. Power without visibility, unlike parliaments or presidents, central banks do not need popularity. They do not campaign. They do not explain themselves in simple language. Their power lies precisely in their invisibility. When things go well, they are praised quietly. When things go wrong, blame is diffuse. Inflation is blamed on supply chains. Bubbles are blamed on markets. Crises are blamed on unforeseeable shocks. Rarely is the architecture itself questioned. And yet, every modern crisis has passed through the hands of central banks. Every boom has been amplified by credit. Every bust softened or worsened by policy. This is not incompetence. It is consequence. The limits of control central banks like to project mastery. Models, forecasts, targets. But economies are not machines. They are human systems, driven by fear, by greed, by belief. When belief holds, systems function. When belief breaks, no policy is sufficient. This is the uncomfortable truth no central banker can fully control. They can manage liquidity. They can influence behavior. They can delay reckoning. But they cannot abolish cycles. They cannot eliminate risk. They cannot print trust forever. History proves this again and again. The next turn of the wheel, every monetary system believes it has solved the flaws of the last. Gold failed because it was rigid. Fiat succeeded because it was flexible. Now flexibility itself is the risk. Unlimited intervention breeds unlimited expectation. And expectations eventually exceed reality. We don't know how the next break will look. It may not be a sudden collapse. It may be a slow grind. a decade of stagnation, a quiet loss of confidence. But history suggests this much. No system escapes its contradictions forever. Seeing clearly, this is not a call for panic. It is a call for clarity. Understanding central banks means understanding power as it actually operates, not as it is advertised. It means recognizing that money is political, even when wrapped in technical language. That stability is temporary, that incentives shape outcomes, and that the most important forces in your financial life are often the least visible. The final thought: central banks do not wake up intending harm. They act within a system built on compromise, urgency, and precedent. But intentions do not negate impact. Their decisions shape inequality. They shape opportunity. They shape the future purchasing power of your labor. They are the quiet architects of the modern world. And the paradox remains. In democracies built on the promise of representation, the most powerful economic decisions are made by those we never elect. That is not a secret. It is the foundation. And once you see it, you can never unsee it.